Hello, everybody. My name is Mark Chupka. I'm the Vice President for Research and Programs here at the Energy Storage Association. Thank you for attending today's webinar on financing energy storage development, matchmaking in a rapidly growing market. The webinar is being recorded. Everyone who registered will also receive a link to the recording and slides within the next couple of days. Questions can be submitted at any time throughout the webinar via the questions chat box in your browser, and we'll get to those after our speakers finish their presentations. In the text of your question, please indicate to whom you would like your question addressed. All meetings and teleconferences of the Energy Storage Association are held in accordance with our antitrust guidelines. We ask that you abide by these guidelines during today's webinar. The full guidelines are available in the members area of the ESA website. If you are not yet an ESA member and would like more information, you can reach out to my colleague, Brenda Lovell. Membership includes free access to all of our webinars, including many that are exclusively for members, among numerous other benefits. So please contact Brenda for more information. Before we begin, I would like to announce an upcoming ESA event. The ESA Virtual Annual Energy Storage Conference will be held on April 21st and 22nd. So please save the dates and check the ESA website for updates and registration information. Today, we are exploring the important process of matchmaking between storage developers and financial entities that will allow the storage industry to accelerate deployments. As with any relatively new industry experiencing unprecedented growth, the need for capital to fuel storage developments will increase dramatically. We're going to discuss how that capital finds its way into firms and projects in the storage industry. I'm delighted to introduce an excellent panel for today's discussion. First up will be Eric Lynch, CEO of Leyline Renewable Capital, who will describe how matchmaking works to meet a variety of needs, primarily in early to middle phases of project development, particularly bridge financing that his company provides. Our next presenter is Deanne Barrow, an attorney at Norton Rose Fulbright, who specializes in energy storage financial transactions. Deanne draws upon her vast experience representing both the developer and finance side of a transaction, and she will describe the process primarily from the developer perspective. And finally, Himanshu Saxena will be next. He is the CEO of Starwood Energy Group, and he's going to comment on Eric and Deanne's presentations, as well as discuss some of the later stage financing and the process of evaluating candidate projects for risk and return that he does. After their remarks, we're going to open up to the audience Q&A. You can ask questions via the question chat box at any time during the presentations, and we'll get to the Q&A session at the end. Now I'll turn it over to Eric.
Thank you, Mark. So Leyline Renewable Capital is a provider of development stage capital for storage and other types of renewable energy projects. So I'll spend some time talking about a little bit about our business model, some of the projects that we have financed, including an exciting recent transaction that we closed, which I think is indicative of the way that we are placing capital in the storage market. Just a little bit about Leyline. We are backed by a $150 million commitment from a private equity fund called New Light. All of our capital goes into bridge lending solutions, which typically happen prior to project construction, somewhere during the development stage of projects. We are heavily focused on solar, battery storage. We have some investments in the wind space. We've also done investments in renewable natural gas projects, things like landfill gas and anaerobic digestion. So we have a fairly diverse set of investments and vertical markets that we lend into. And I think it's important to understand that our approach to the market really comes from our experience, having been on the development side of the business for the past 15 years. So most of us over here at Leyline have been actively engaged in the development of projects. We understand the risks and the challenges, as well as the opportunities that developers face in renewable energy project development. We do take a long-term view of the market, And we also are small enough and nimble enough that we can act quickly and provide flexibility in our solutions for developers. We really start with solutions in mind, and our goal is to get projects over the finish line, get them into construction, get them up and running, and get them to the point where folks like Starwood Energy Group can come in and own and operate the projects, longer term. So we really are that bridge solution for maybe anywhere from 18 to 36 months during that critical development stage of a project. We typically do exit at or near the start of project construction, so our capital is used for all the things that are required to get projects through, permitting and secure offtake agreements and all the myriad of different things that you might expect during the development phase of a project. And we have a pretty wide range of check size. We've done transactions as small as 500,000, and we've done our largest transaction was a $50 million transaction we closed on last year. So a lot of flexibility in deal size and phase that we come in or stage that we come in on the project. So what is development stage, financing, and what are the problems that development stage capital is really seeking to solve? And the biggest problem, I would say, the biggest challenge that developers have is how do they get their project across this significant gap and over to a point where it's ready for an institutional investor to come in and commit much larger amounts of capital. And oftentimes we find that developers and what they consider to be a shovel-ready project that's ready to start construction doesn't actually meet the requirements that the investor has on the other end. So our expertise comes into play here, as well as the capital to get them to the point where the financiers can come in with the larger amounts of money, whether that's bank debt or equity. So again, closing that bridge and creating a smooth transition from early to mid-stage development all the way through to the long-term owner. Transaction that we closed on recently here, which is sort of interesting, and I think is indicative of the way you're seeing capital flowing into storage projects right now. We did a transaction with a couple of individuals that recently left a large engineering firm and decided to go out on their own, and significant amount of experience with this team, which got us comfortable in backing them. So we provided a lending solution here to allow Davian and Ed and the two principals of Momentum to really go out on their own and to use all their experience to identify opportunities in key markets for developing storage projects. And so this has been pretty exciting for us, in part because oftentimes these projects, unlike a solar project, don't have a lot of real estate related costs, and so typically the costs that are needed and the capital that's needed for a storage project oftentimes is the engineering and the technical and the development just the time for the principals to go out there and identify opportunities, find those opportunities, and get them signed up. So by backing a company with some capital as well as their projects, they've got the flexibility and the capital they need to grow over the next 5 years into a really solid developer. And together we're really going after new markets, and also again just moving that needle in the fight against climate change, which is really core to what we're out to accomplish. Some technologies that we're focused on and that we see opportunities for growth, both in development and equity and debt capital. Solar and wind, where we've been historically very active. Storage has been something we entered into with our first transaction about a year ago, and again actively continuing to move forward in that space. And then the electrification of the transportation sector, we think is a big area going forward. Storage will play a key role in that. And then, as I mentioned earlier, we are active in dairy and ag and anaerobic digestion on the renewable natural gas side. In terms of the types of capital that you might see come into a project, a lot of our early stage capital is in that higher risk development capital. As projects move through development and enter into the late stage development period, you oftentimes will see lower risk types of capital needed, which is again still pre-construction, but you may have refundable deposits, you may have equipment deposits, those things that are maybe fairly fungible, and we would consider those lower risk. And then getting into hybrid sources of capital, things like coming into construction or entering into joint ventures where some of the capital may be used for things like working capital and other uses. And then potentially, as we look forward, we think there are opportunities in things like repowering, adding battery storage to existing, solar projects that were put in place, 5 or 10 years ago. So just I think there's going to be a lot of activity in the coming years around interesting areas, niche, longer duration type capital needed as well. So I will pass it on from here to Deanne to talk about what they're doing over at Norton Rose.
Great, thank you, Eric. Let me begin by saying thank you to the Energy Storage Association for putting together this webinar. It's so timely, and thanks too for inviting me to give this presentation. It's a real honor. Right? So I divided my presentation into 2 parts. The first part focuses on equity financing, and then I'm going to get into debt financing. In terms of equity, I'd like to take the group through the developer's perspective on matchmaking, on choosing the right equity partner. So specifically, I'd like to talk about considerations developers should have around timing, control, and project sale. And then in the second part of the presentation, I thought it'd be interesting to kind of give the group some ideas for creative structuring for debt financing. And this is based on real life deals that I've worked on, both for debt financing for early stage development as well as construction stage projects, energy storage projects. All right, choosing the right equity partner, the developer's perspective. So generally, different developers have different needs in terms of an equity partner. And what the company needs is going to be the inverse of what the company has. Now, in my practice, I generally see the needs of energy storage companies falling into one of 3 buckets. So it could be, right, you got like a bunch of UPenn MBAs forming a company, and they lack expertise in terms of putting together projects. So then they seek an equity partner that brings what they lack to the table, namely technical and commercial expertise. And they'll look to that equity partner to guide them through things like, what markets should they be thinking about entering into, and basically how to put projects together. Another area is experience. So some companies seek out equity partners specifically for the experience that they have with, say, project financing or project administration. But most commonly, what I see is a company, seeks an equity partner to provide capital. So this is either someone that simply writes checks or someone that has credit. A common pattern is a developer that has experience to develop storage projects but lacks the means to post credit support. That could be like an LC to get a queue position or to make a deposit for equipment supply, or an LC that is required of a seller under a PPA. And they just don't have the credit to provide that sort of stuff. So they seek a partner with money. That's the most common situation, and I'd like to discuss a number of issues that maybe are not so obvious that the parties should be thinking about at the outset. So the first is timing. The opportune time to bring in an equity investor really depends on the stage of maturity of the pipeline. And this is not always true, but as a general rule of thumb, the more ripe your projects, the more attractive investment terms will be for the developer, right? So generally, it makes sense to scrape up funds during early days and bootstrap your venture as long as possible, and then you can get the best terms the more ripe or the later stage your projects are. when I say investment terms are more favorable for the developer, the later the stage of the projects, I'm primarily talking about price. And there are a number of parameters that could make up price. One is carry. So you'll see generally higher IRRs the earlier the projects. You might also see a preferred return in favor of the investor the earlier the projects. And that just means like the investor will get a distribution of profits ahead of the sponsor until the investor achieves a certain return on its initial investment. So just think about that. Do you want to wait until your projects are, bootstrap your venture, wait, and then get better terms when you're a little further on in the process? First thing to think about. Okay, second thing is control. So generally, a developer should focus on how much control it wants to give an equity partner over development decisions versus simply giving them information. So this goes back to what I started with, right? Which is haves versus needs. If the developers bring to the table a long history of developing projects, then it could, make a strong case that like, look, I should have independence over development decisions, and basically just give the equity partner a heads up rather than coming to them for consent or approval. Now, if the equity partner will be financing multiple projects over time, then the general thing to bear in mind here is the investment agreement should really hardwire a set of criteria for adding projects to the financing. So the parties should discuss the process by which one party presents a project for the other's review and approval. And also, very importantly, whether economic sharing ratios should be fixed for all projects, and if they won't be fixed, how they're going to adjust as more projects are added. So, the idea here is pre-bake into your agreement and approval process. And if you're a developer, the criteria should be as objective as possible, right? Because you don't want to provide opportunities for your funder, your capital provider to have an out, to say like, I'm not funding that project. So try to make them as objective as possible. And then in terms of economic sharing ratios, there are like a myriad number of options for sharing cash. The most common approach I see is just a simple fixed ratio. So based on the value of the contributions that each party makes. So the money partner is generally contributing cash and the developer would contribute sweat equity. And then the key there is how you're going to value the non-cash contributions. All right, project sale. So definitely this is true that not every storage business is going to follow a develop and flip model. So one of the things you want to do, talk upfront with your equity partner on what the expectation is going to be. So we just heard Eric say that like generally in terms of exit, he will exit at or near the start of project construction. So that's one thing you want to agree, like are the projects going to be sold at NTP, COD, or is the plan to retain operational assets long term? Is the plan for the developer to own the asset after development has been completed, or is the expectation that the projects will be developed jointly and then when they hit NTP or COD, sold to a third party? Now, in my experience, most of the times, like parties just don't know exactly what the end game should look like at the time they're structuring the investment, and that's totally fine. If that's the case, what we do is we just build in some flexibility into the investment, and that's generally done through a ROFR or a ROFR. So a right of first offer or a right of first refusal for one of the parties to buy the other party's interest in the project before going to a third party. And I just mentioned there that probably a right of first offer is preferable, because what I've seen is if you have a right of first refusal, sometimes these third party buyers, they get skittish or they get kind of, they don't want to spend time negotiating a deal, and then you can just have the ROFR entity come in at the last minute and match the terms, and then the project has to be sold to that entity. So generally, ROFR works best for flexibility. All right, so part 2, I wanted to share with the group 3 structures that I think are not so obvious. So basically, I've seen these structures deployed, utilized in energy storage development and construction financing. So these are examples based on real life deals. And I just want to add the caveat that like what I'll be presenting is it's not written in stone. Like there really are no rules, we're just writing the rules. So if you see something that I'm presenting here that, you know, kind of piques your interest, but it doesn't really fit with how you've been thinking about things, like get in touch after the webinar and we can talk about, you know, your specific fact situation and kind of how we can kind of mold these structures to fit your needs. All right, so the first thing I wanted to talk about that I've seen deployed is equipment vendor financing. Now, this structure was actually used in the Key Capture Energy deal that closed last week. And I mean, for those on the phone that are like, oh my God, you know, Jeff Bishop's gonna kill Deanne. No, it's okay. Jeff told me to go ahead and I could talk about this deal. So first of all, you know, big congratulations to Jeff and his team. Jeff, Ann, Jim, Rachel, Emma, many more on the Key Capture Energy team. They just closed a $73 million construction term loan that is backing a portfolio of over 200 megawatts of standalone storage in ERCOT. And I had the distinct privilege of helping the lenders out on that one, Rabobank, CIT, and Siemens Financial Services. So, I mean, there were many unique aspects of that deal, like enough to fill a whole webinar, but talk to Jeff or Anne if you want to hear more. I'm just going to focus on one aspect, which is the equipment vendor piece. So, all right, equipment vendor financing, what is it? Well, what I've seen is a lot of new competition among energy storage equipment vendors. And to distinguish themselves in the market, some vendors, some big industrials are including credit enhancements such as deferred payment terms with their equipment offerings. And it's a point that developers, I think, maybe don't know about, but could keep in mind before they assume that they need to raise construction debt. Or even if you are raising construction debt, equipment vendor financing can be a helpful add-on to your financing package. So what does it look like? So this is an illustration, and I do want to say this did not come from the Key Capture deal. This is just how it could look, not that it looks like this in Jeff's deal. But so here at the top, I've got you know, the typical milestone payment schedule that you might see in a storage EPC contract. You know, you're paying a security down payment at LNTP, then you have a certain percentage of the contract price at NTP, and then you pay percentages all the way until you hit final completion. What we're seeing some equipment vendors do is offer a deferred payment schedule. So you're still paying generally a down payment at LNTP and a payment at NTP, but then you don't pay anything until you hit substantial completion. So what's the benefit there? Well, obviously, you know, you're avoiding interest on loans during construction, because generally you're not going to borrow until you get to this stage, which is at this point your project is up and running. And so what you're seeking there is not construction financing, but term financing. Even if you do borrow upfront, like construction financing, the benefit of having the structure in place is that you're presenting a far less risky package to the construction lenders, because you're not going to need to borrow from them until the project is basically complete. So you're eliminating construction risk. So big advantage there. All right, second interesting kind of idea, modularity. So this is a unique feature of battery storage projects, right? And it can be used in some cases to reduce financing costs. The modular architecture of batteries in some cases allows financing parties to exercise the self-help remedy of physically taking back the collateral, the battery, in a default scenario. If you think about it, that's not true of most other power projects, right? Like you can't necessarily go rip a wind turbine out or a solar PV out and like use it. So for storage, it's an extra layer of protection for financing parties, and it could reduce the financing check. We have seen that used. All right, I'm nearing the end of my time. So the last interesting sort of creative idea I've seen employed is the real estate spinoff to support a development pipeline. So I've only seen this done by what I would call very sophisticated energy storage sponsors, but if you look at the structure, there's really no reason that this could not be employed by any sponsor in the market. So what's happening here is that sponsors are separating ownership of projects from ownership of project real estate. And then what they do is the lease payments from mature projects are used to secure a letter of credit facility that supports the sponsor's future development pipeline. And the rent payments that they get from the mature projects are individually small, but if you bundle up enough of those, they can support a decent size LC facility. So I made an illustration of what this looks like. So over here, you've got, your project companies, which are basically, they're not early stage development. They might be like under construction or even operational. And each of them has been project financed. But these guys don't own the real estate. This guy does, the land holdco, which is an affiliate of the sponsor. So the project companies are paying rent, they're making lease payments periodically to the land holdco. That payment stream, the sponsor then uses to get an LC facility to support development on like a completely different, unrelated set of projects to these. Okay, and the reason the LC issuing bank is willing to lend against this payment stream is that really these lease payments are being paid or financed through these guys, a separate group of project finance lenders, but the payment stream is pretty secure. All right, so let me stop there and hand it over to Himanshu.
Thanks, Deanne. Himanshu, if you'd like to make some comments about what you heard or tell us how Starwood conducts itself in this very exciting market.
Yeah, hey, good afternoon, everyone, and thank you for having me on this webinar. I am going to be the one who did not prepare slides, so I would just, talk over the next 5-10 minutes, kind of tell you about what we see in the storage marketplace, and why we think it's an exciting area. You've heard a lot from Eric and Deanne around structuring the deals and certain development risks. And Eric and Leila and team have been doing a great job working with the developers in moving many of these projects forward. So I'll try to cover that a little bit because there is a lot of commonality between what Eric does and what we do in terms of helping developers move some of their projects forward. But before I go there, let me tell you a little bit about Starwood. For those of you who might not be familiar, Starwood is a well-known name in the hospitality business. It really started with a company that was created about 30 years ago called Starwood Capital Group, which is a real estate focused investment manager. And over this 30-year period, we have developed a portfolio of real estate assets that are approximately $70 billion of assets that we currently manage. We have offices in 11 countries, about 3,000 employees. We created Starwood Hotels. That was a portfolio company of ours many years ago, spun it off as a separate public company, and now have no commonality of ownership, though we gave them a license to use the Starwood name, which is where they got the Starwood Hotels name that you all know. Our firm started investing in energy infrastructure about 15 years ago. I've been here for effectively the entire duration of that period. We have set up a team and have set up a business where we invest in energy infrastructure projects and have been doing that for about 15 years now. We are currently managing about $6 billion worth of assets. And the asset portfolio is very broad. So we have three major parts to our business now from an investment standpoint. One is investing in power generation and transmission assets, which includes everything from gas-fired power plants to wind farms, solar projects, battery storage projects. We have built the largest biomass project in the country, so we have had exposure to biomass. And in the power generation transmission business, we have been really looking across the board. We are technology agnostic in many sense. We are always looking for what's sort of coming around the corner, and that's what storage is these days. Well, now I'll talk about that in a minute. We are also a large investor in transmission. We've built 2 large high voltage DC transmission lines underwater in the Northeast, Neptune and Hudson. Each project was about $1 billion. And we are currently in the process of developing a big transmission line in California that will connect Arizona into California and would provide a conduit, a highway to connect a lot of renewable energy, including battery storage that's being developed in Arizona to supply the needs of expanding needs of California buyers. So we have been a big investor in the transmission business. The other 2 silos of our business include midstream, where we have selectively made investments and been looking at investing in gas pipelines, gas gathering systems, things like that. But that's not been a huge focus lately. And then finally, we have invested in downstream chemicals. We are building a very large ammonia project in Texas, and being in the ammonia business has effectively put us really close to the hydrogen business. We are looking around and seeing what happens next with the whole hydrogen economy that's effectively coming, and every other day there's a big discussion around hydrogen. So we have exposure to the past, which includes gas and thermal assets, and we are creating exposure in our portfolio to the future, which includes storage, decarbonization, CCUS, and hydrogen. So we have our fingers in a lot of different pots. Historically, we have spent about half of the capital, or I should say invested half of the capital in greenfield projects. The other half has gone into brownfield projects. So we are prolific developers ourselves, and we are also active acquirers of operating assets. So we have been through that entire life cycle. And when Eric was talking about the risk in development projects and the riskiness of that capital and the scarcity in the market for getting development capital to move some of these projects forward, we really see that, we empathize with that. A significant part of our business model is working with developers, and over the course of this last decade, we have worked with numerous developers in helping them move their projects forward. Sometimes it's with capital, sometimes it's with our relationships and our expertise. So we have we usually work with developers, and Deanne talked about the transaction structures. We have really used every one of those structures. Every developer has a different desire to in the relationship that they are looking for. Some are looking for development capital, some are not looking for development capital, they are simply looking for construction capital. Some want developer fee paid up front and really want to exit and recycle that capital in their future development pipelines. Others want to stay on and operate and manage the asset. Some want to keep an ownership stake, some like preferred interests, some like carried interests, others don't. So we find that there are as many transaction structures with developers as there are developers. There are definitely some common themes. But as an equity investor partner, what we pride ourselves in is being nimble and being responsive to what our developer partners are looking for. So we will come in and help the developers move their projects forward and get it through the construction stage. And what Eric is doing is really a unique need in the marketplace. There is always a lack of development capital. There are always more developers and more projects than there is development capital. And historically, we have funded development capital for some of the developers, but we have always found that segment to be undersaturated. Compared to that, for high quality assets that are in construction or they are in operation, there is always more capital available. And given the ESG bent that we see in the marketplace, and you don't have to go far just look at the stock price performance for companies like Plug Power and Fuel Cell Energy over the course of 2020, and then looking at the specs and what they have done with many of these EV companies that they have bought and how the share prices have performed, it is very obvious to everybody that there is just a huge tailwind and heavy premium on valuations for anything that looks like a good ESG story. One could argue that many of these valuations may be completely out of whack, but keeping that aside, there is just definitely a lot of demand for high quality operating assets in the renewable space. So we see a lot of capital chasing a finite set of assets, whether it's wind, solar, storage, solar plus storage, increasingly EV, and the now hydrogen and fuel cells. So the capital availability has just never been an issue for operating assets. It's always been an issue for development and construction asset. And if we can play across the food chain, we like coming in at a point where the development is a bit de-risked, but we can work across the food chain and like to partner up with folks like Eric that can help a developer kind of give them a full life cycle of risk management and life cycle of capital to get their project from point A to point B. So that's kind of what we do. Let me talk a little bit about my views on storage. And Mark, I'm not keeping an eye on the clock here, so either text me or chime in if I'm going over time. But look, storage is a very exciting area, and something that we all have been looking at for the last many years. We back in the days had partnered with STEM. That was our first storage investment. We had developed or funded actually a number of storage projects that STEM was building behind the meter. So we are proud owners of, I think, 52 behind the meter battery storage projects in California right now, and have been monitoring for the last several years on how the battery storage projects are actually utilized by the system. And we think that the market has come a long way in not only figuring out why storage is important, but also how storage assets can be integrated into grids, how they can provide the reliability support and other things that are needed as we put more renewables on the grid. You don't have to go far, just go to California and look at the numbers. The announcements around the extent of curtailment for wind and solar in California is just staggering. A lot of this renewable energy is getting wasted because there is not enough transmission to get that out of California. There is not enough battery storage to store it on the grid. So both from a social standpoint and from an environmental standpoint, we think storage has to be an important part of the energy supply chain. And we have also very closely monitored the evolution of the cost curve in storage. It used to be that when we would look at the cost numbers on storage, they were at $600-700 a kilowatt hour just about 2 years ago. Now we are seeing numbers that range from anywhere from $250 to $350, maybe $400 a kilowatt hour. So the numbers are coming. Everybody says that it has to be less than $100 a kilowatt hour for it to be competitive or broadly competitive. It's not there yet. It's still quite expensive. Probably 3 times that 100. But we definitely see a trend of the cost coming down, and I think the more the cost comes down, the more storage becomes a viable solution to solve a lot of problems that renewables will create invariably, like they have created in California. So we think that's an important part of our investment thesis going forward, is to invest in battery storage projects. There was an announcement today that with the Green Act that Democrats might want to reintroduce in the House and the Senate, has a investment tax credit piece for battery storage. If that happens, then obviously it would be very helpful to partly defray the cost of what is still a very expensive solution in many cases. The other thing we see in addition to cost evolution is just an increased demand for battery storage. So increasingly every RFP that's come out, whether it's from utilities or even from corporates, has now a battery storage component to it. So all these solar plus storage projects that are currently being developed are pushing sort of storage onto the grid. That has been an interesting thing to watch in the last year or so. But we see a lot of investment opportunity coming that way. I think the big issue we see candidly with storage investments is that the revenue models on storage are still very early stage and in many cases very premature. So for example, 10 years ago when wind and solar were just taking off, you were able to get bus bar PPAs on your wind or your solar asset, which gave you a full price assurance for 15 to 20 years. Utilities gave you 20-year PPAs where all you took was the wind resource risk or the solar resource risk. But as long as you kind of operated the asset properly, you had no risk on the price. Now, what we see with battery storage right off the bat is that the full tolls where revenue risk is transferred to a customer, those deals are effectively non-existent. And sponsors, developers alike are taking a lot more risk in investing in storage than they would have taken 10 years ago investing in things like wind and solar. So for example, California storage projects, a number of them have been built and a number of PPAs have been awarded. For those deals, there is a capacity component to this, the RA contracts that the utilities have issued for some of these storage projects that range from 10, 15, 20 years. They provide something close to 30 to 40% of the revenues that those assets are expected to generate. So as much as 60 to 70% of the revenues still come from merchant markets, whether it's from ancillary services or otherwise. And those revenue streams are actually quite hard to underwrite, given a certain volume of storage on the system would effectively hurt the profitability of the system that have already been installed. So a little bit like the hotel business, right? You build another hotel in Midtown Manhattan, everybody's rents will go down. And I think that's a risk that investors are taking. Thankfully, for developers, there is enough capital in the marketplace that's looking for storage and for ESG-focused investments that people are willing to underwrite that risk and they are willing to price it. So the deals are still getting done. Other markets such as Texas, there is not even a capacity component to the revenue stream. And there are folks that have some innovative hedges that they have put in place, and that provides certain degree of risk mitigation, but it's not simple, and it's definitely not without its own risks. So we are hoping, as an investor, we are hoping that certain markets such as New York and Massachusetts and others that have talked about putting a lot more storage on their grids, they can come up with somehow perhaps better mousetraps on how to pay for battery storage. There was an announcement that a New York asset that is being developed by one of our fellow sponsors is being sort of pushed out another 3 years because they haven't figured out how to get paid for the battery storage asset. So I think there's a lot more that can be done from an investment standpoint on the batteries, if only we can convince the utilities and the state regulators to take a little bit more risk on the offtake side. If there were simple plain vanilla tolls that were available, I think a lot more capital would show up for the space. And I think the last few comments are around the evolution of the storage assets itself. So what we have seen just in the last 3 months is that a lot more RFPs are looking for long duration battery storage. So it used to be that everything was 2 hours or 4 hours. We are starting to see a demand for as much as 8 hours and 12 hours of battery storage, and the fundamental use of that would be very different. This is really load shifting more than just responding to market needs on a minute by minute basis. So we think that unlike wind and solar, storage would be quite a bespoke product for their local markets and for the local needs of the customer. So I think that makes it actually a really interesting, because it's not going to be a one size fits all, and creativity around solving customers' problems are going to be very important to build and own and operate these systems. So that's my off-the-cuff, unprepared monologue around storage, and I will pass it back to Mark and see if anybody has questions. Happy to engage in any dialogue now on anything I might have said.
Thank you, Himanshu. That was quite interesting. And I'd just like to remind everybody that you can continue to submit questions through the chat box in your browser. And we've already accumulated quite a few. So I'm going to start with one that went to Eric early on in the presentation. What do you define as shovel ready for purposes of obtaining a development loan?
So for purposes of obtaining a development loan, by definition, the project would not be shovel ready. We would be providing capital, or you'd get your development capital prior to becoming shovel ready. And then shovel ready is one of those things we sort of chuckle about a little bit internally, because it can have different meanings to different investors, I would say. But our definition is that it is fully permitted, you're fully through the interconnection process, you're effectively ready for someone like Starwood Energy Group to come in and start construction and start putting capital to work in the project. So really all of those items required to start construction and to obtain typically bank financing and or your equity financing. But we really look to the equity side of the transaction to really define what they consider to be shovel ready, but certainly fully permitted. Interconnection off-take's a big question. And in storage, of course, you're not going to see typically a PPA type long-term off-take. So you'll have to have a pretty well thought out and put together revenue strategy, or a partner or a strategic that's ready to come in and sort of take on and assume that risk. But all the typical things that you would see again during to get a project fully permitted, obviously full site control, all of those things buttoned up and tight and really done to institutional investment quality standard.
All right, thanks. That's very helpful. Deanne, there's a couple questions for you. They're kind of related, so I'll give you this first one. What types of equipment vendors have you seen provide deferred payment terms? Are they battery suppliers, inverter suppliers? Who's giving these deferred payment terms?
Yeah, sure. These are integrators, BESS integrators, so battery energy storage system integrators. So they're not the OEMs, they're not the Samsungs or the LG Chems or the Cattles. These are, without, I mean, you can talk to me after the webinar, but these are guys that are big industrial suppliers of the system. So your EPC contractor or your integrator, you would not let's say you got a $50 million EPC contract. They're saying to you, the storage developer, you can pay 20% at NTP, and we'll wait until I'm done. The equipment supplier and the EPC integrator, we'll wait until I am done constructing the project, and that's when you'll pay the bulk, the 70% or what have you. And the other interesting point here is that in addition to the deferred payment terms, these guys are also providing full wraps on the project. And historically, what is difficult to finance about, or one aspect that makes financing energy storage difficult historically, from what I've seen, is that your EPC arrangements get chopped up, right? So they get split up among, I don't know, say like the inverter supplier and the battery system supplier and the container and the HVAC. And you got like warranties and performance guarantees that are sort of like a puzzle that don't fit together, right? That don't line up, and it makes it difficult for investors and financiers and lenders. So in addition to the deferred payment terms, we're now seeing these big integrators provide wraps, and they're basically a one-stop shop. Makes it a lot easier to finance these projects.
That does sound quite valuable. I think you've probably implicitly answered the second question, but here it is. The providers offering deferred payment schedules, is that seen on utility scale projects only, or are they seeing that on smaller commercial and industrial energy storage projects?
Yep, on both.
On both, okay. Excellent. There's a question that came in. Let me just manage this a little bit. This can be this is probably best for Himanshu or possibly Eric, but here's the question. How do development costs and financing costs change as you move to secondary markets such as Latin America? What is the importance of location in the willingness to invest or lend? And I could actually embellish that a little bit. Are there regions in the U.S. that are different in terms of financing costs or perceived risks?
Yeah, so I could take that, and Eric, maybe if you have views on this, obviously, please do share. So we have looked at south of the border for investment opportunity, like most people have, and we see a lot more market construct risks in south of the border than we see sort of north of the border. So Mexico is prime example of how to screw everything up, what the current government is doing, and with daily changes effectively and messing with foreign direct investment, and particularly with renewables, there's a complete chill of development capital, or even sort of construction and operating capital availability for investments in Mexico. So we think that markets are interesting because there is load growth, and they clearly need more renewable energy. They need more of all kinds of energy. But the risks investing in places like Mexico and in that sense many other Latin American countries is actually materially higher than what it is in the US and in Canada or in other developed economies. So there is definitely a significant premium for what anybody would charge supporting development in south of the border than north of the border.
Yeah, and I would add that there's also challenges west of the border, and I would say what I mean by that is California. California is a whole other animal, and they have large targets and mandates around storage. Projects out there tend to be very, very large with large development capital budgets. We've generally just sort of not necessarily shied away from California, but we're a little more cautious there because of the long development cycle, the permitting, and just the costs to sort of actively engage in that market. So most of our activity has been either in the Northeast, PJM market, ERCOT, down in Texas, is generally where we're seeing, and then also some specific states that have policies like Virginia with the 3,000 megawatt mandate out there now, and I think Connecticut's about to roll out some policies. New Jersey also has some favorable policies. So on a state-by-state basis, we like favorable kind of policy backdrops.
Okay, thanks. Quite interesting. I have another question for Deanne, but it's a bit long. Let me see if I can condense it a little bit. The person is interested in the perceived creditworthiness of energy management system firms, many of which are smaller startups that might not yet be backed up by a larger entity like a utility or OEM, but could add significant value to a project. Are additional credit support such as performance, bond, cash, and escrow seen as the solution for credit risk here, or is just having a clear EMS replacement plan seen as the best solution if the EMS software provider goes under? So it's a really question about creditworthiness of EMS providers.
Yeah, absolutely. The approach I've seen in getting deals done is sort of an all of the above. So there are specific insurance products available in the market, sort of targeted to early stage, either early stage companies or just, maybe EMS companies that do lack that balance sheet to be able to support the offerings that they are making. And let me just say, I mean, the EMS market is, it's bursting with innovation. I've seen some really innovative performance guarantees, some revenue sharing options. I mean, there's a lot of interest, I think, on the customer side. And so the real hurdle there is just what the question alludes to, credit. So definitely, certain insurance products could be available. I know New Energy Risk has one. I think Energetic Insurance might also have one. So that's one approach. The second approach, a performance bond with cash and escrow. I've not seen that employed, but I've definitely seen the analog to that, which might just be sort of a reserve or a lockup on distributions until, say a certain cushion is maintained, and until the contracts have sort of performed on a longer term basis, and there's more assurance and sort of comfort that the EMS provider can actually achieve whatever it's guaranteeing, whether that's demand cost reduction or a lower utility bill or whatever have you. And then the third interesting way I've seen that dealt with is through a software escrow, a software lockbox. So, and this can be really important, I think, for behind the meter EMS providers. So they will essentially put their algorithm with a third party escrow agent, right? So their algorithms, all their IP, before it's locked up, generally, either the customer or the financing party will want to have a chance to inspect the code. I'm not a computer scientist, so I don't really know like what they're inspecting, but I guess they're inspecting to see that the integrity of what's being put away in the lockbox makes sense. And the idea is that it's put away in escrow or in this software lockbox, and then if any sort of trigger event occurs, then the escrow agent will release it to either the new owner of the project or a new operator. And this is important. I mean, trigger events could be things like, obviously, like bankruptcy, but not necessarily bankruptcy. It could also just be that, say, the EMS provider decides to pivot its business, and maybe they decide like, hey, software is not the thing for us, or hardware is not the thing for us. I mean, whatever it is, and they kind of shift to doing something else, and then you want to be able to have a new EMS provider have the ability to step in and still run those projects. So that's how I've seen it done.
Okay, thanks. We're just about at the end of the hour, but I have one more question that any of you might take a crack at answering here. Does the team think that groups with financial investment interest only have an advantage or disadvantage versus a self-financing developer, owner, or operator? So is matchmaking required, or can some people sort of go do it on their own?
So I I can start on this, and then Himanshu, you might have some thoughts as well. I think more and more, I mean, it does, I guess it does depend to some extent on the size of the project and the type of the project, but some of the larger transactions that we've looked at, I think it's pretty important to have a balance sheet in the room, and not only to carry out the important costs of development, but that long-term owner is going to have a view on the market that is going to, I think help inform how the project moves forward through development, and even to include the actual location or the specific node where a project might be located. So I think that larger standalone storage projects, in our view, come together and have a much more likelihood of success if you have at least a relationship with a balance sheet and someone who's taking kind of a longer term view and has an informed view of the full life cycle project economics, including the technology and the bankability thereof. So I do think it's important. We consider relationships with groups like Starwood Energy Group to be really important as in informing our decisions before we put capital to work. So I do think it's important. I don't think it's absolutely a deal killer if you don't, but I do think it's important. Himanshu, I know you see a lot of different kinds of projects and developers, and may have thoughts on that as well.
Yeah, I think everything you said, I agree with it. There are so many different kinds of developers. On one extreme, Nextera is a developer, right, technically, and they have all the technical capability and financial strength to do everything from soup to nuts themselves. And they obviously would never need to partner up with somebody else like us or like you, Eric. Then on the other hand, you have developers that maybe a couple of guys that have really good ideas, have local access and the right sort of relationships with the customers in certain markets, and they have very limited financial wherewithal to move projects forward, and also have limited relationships with folks like Fluence and GE and ABBs of the world or Samsungs of the world to not only get the best pricing on the equipment, but also go get tax equity if there is a tax equity component to this. Financing is another one. I mean, at some point, relationships and long-standing sort of value that sponsors like us can provide can be the difference between getting a project to be built or not be built. And if we are there with the developer during the cooking stages, whether when they are negotiating a power purchase agreement or a capacity agreement or a turbine supply agreement or a maintenance agreement on storage, we know what's financeable, what's not financeable. We know what works for us, what doesn't work for us, and generally have a pretty good sense for what works for the market. We can make sure that the developers don't have missteps along the way, so that when they get to the true shovel ready stage, those projects really are good to go. And those lessons learned that we have had in projects that we have worked with in the past can be instrumental in avoiding these pitfalls. And that, I think, is value that's above and beyond any money that we could provide to these developers. So we see this as real partnership between developers and us, where we help them financially and really with our expertise to move this project forward. And that's been a winning strategy for us so far.
Okay, thank you very, very much. And we have arrived at the end of the hour. I'd like to thank the presenters for a very informative session. Before we conclude, I'd like to remind you to save the dates of April 21st and 22nd for the ESA Energy Storage Virtual Conference. And I'd like to thank you. Best wishes for the rest of your day, and hoping that you stay safe and healthy. Bye-bye.
Thanks, everyone.
Thanks.